Hi everyone. I am Saurabh Gupta. I'm part of Quantum Mutual Fund's equity investment team. I manage equity funds for Quantum Mutual Fund, and we are known for equity value investing as a style. So we thought we'll share our thought process on what value investing is, and what are value funds, and what are benefits of investing in a value strategy. So if you look at what are value funds, value funds are funds which invest in value style of investing. Value to the thought process is value. So if you look at last 1.5 years, value funds have done well. The category returns is closer to 68% vis-a-vis. If you look at the benchmark Sensex returns, it's closer to 52%. So a very sharp outperformance by value category, and this has come after a long hiatus. So 2016 and 2000 till 2016 and 19, things were very tough for a value manager because markets were very polarized. The markets moved up because of liquidity. There were no earnings upgrades that were happening on the corporate side. Economy was slowing down. So clearly, value style and value funds were not doing well. It was a tough time. Post the pandemic, when the markets fell, the value managers like us got an opportunity to buy into some good names, market leaders at a great valuations in that fall, and that kind of recalibrated the portfolio. Plus, because when the economic recovery happened post the first lockdown, the economic recovery was quite broad based, and we saw reasonable earning upgrades happening because of cost controls by the managements, and that resulted in some of the catalysts in the value stocks play out, and hence the value styles have outperformed. Now, value. What is value? What is value funds? So as I told, value funds practice value style of investing. Now, value style of investing is a style wherein once we arrive at an intrinsic value of a company or a stock, which is the fair value, we wait till we get it at a discount to that fair value. Now, that discount could be different for different people. Why is that discount? That discount is essentially, in kind of theoretical language, is called a margin of safety. So if you have arrived at an intrinsic value of a stock through various valuation methodologies like cash flow discounting or P multiples, that's 100 rupees. You won't go ahead and buy that stock for 100 rupees. You will wait. You'd wait for a market action or some near-term disappointment, which reduces the stock price to below 100 to maybe 80 rupees, 70 rupees, 60 rupees, and then you go ahead and buy it. Now, that margin of safety is important because whenever you are investing in stocks, you are investing in essentially future, and future is very dynamic because of the government policies, the external environment, the exports, the imports, and other things. So there are chances that you go wrong. So to save ourselves from going wrong and resultant loss of capital, we do not buy things at fair value, buy it at a discount to that fair value. That essentially is value investing, and that's what a value manager practices, and that's what value funds offer to you. How do you identify a value fund? Essentially, the characteristics of a value fund is, at sustainable basis, the PE multiple of that fund should be lower than the benchmark. So a P multiple of a value fund should be lower than that of a Sensex or a BSE 200, whatever the benchmark is. Second, the dividend yield of that fund essentially should be a bit higher compared to the broader markets, because since you're buying stocks at a little lower value, your dividend yield essentially should be higher than and the benchmark or the growth funds. That's the second point. Price to book should be lower than the benchmark, and the risk adjusted ratios like Sharpe ratios should be better than the growth funds, because you're essentially taking a little less risk than the other funds. So essentially, that are the traits of a good value fund. Now, the question arises, what are value stocks? So as I explained, how do you identify a value stock? Essentially, often people confuse that a value strategy is a contrarian strategy. That is not true. It may look like that people like us who invest through value styles go ahead and buy stocks which nobody is buying, nobody is looking, and just wait till the time fortune turns. That is not true. Every stock has its own value. A very high quality name will have a value just 10% to a 10-20% discount to the fair value, because there is less volatility in earnings, like FMCG, or a very high quality bank. For another PSU, the discounts could be higher, right? So value style is essentially not giving that kind of premium to growth. That's how you just wait. So I'll just explain it very in very simple terms. whenever you go out shopping, either you buy at MRP or you buy at discounts, right? So buying stocks at discounts is essentially value investing. Stocks might not be different. So there are, every stock can come into your margin of safety and discount, but you have to wait for that stock price patiently. And when the time comes, you have to be very strong-willed enough to go ahead and buy it. Such a time was March 2020 when everything was falling. And at that point in time, the processes that we have told us that this is the good time to buy stocks which are available at 40-50% margin of safety. And when most people were selling, value investors ideally should be buying, and we were buying. So that's how it works. So that's how value stocks work. They should have a catalyst. They should be available at a discount, and you should be able to wait till that catalyst play out. So essentially, it should be a little longer term investing and not a quarter or a next quarter investing. Now, the difference between a growth strategy and a value strategy is essentially premium to growth. So now the growth manager essentially thinks that whenever he's investing, he can invest at a fair value or a higher that fair value. But since the growth he can predict the growth of the company, the growth will make the stocks cheaper. Right now, he is betting on his ability to predict the growth, which can sustain for a longer periods of time, and he believes that he can buy that stock, hold on, and growth, because it's a superior growth company, that growth will make the stock cheaper and hence will generate returns for him. Chances of going wrong essentially increases. It's a more of an aggressive strategy. Whereas if you look at value style is that you value a company, you know that what could be a sustainable growth rate for that company, and then you arrive at a discount where you want to wait and then buy into the stock because you don't want to pay a premium for that growth. So you are looking at risk before return. You are ensuring that you minimize the risk of permanent loss of capital of your portfolio. So that's the essential difference between a value style and a growth style. Now, the important question is, who can invest in value funds? Everyone. Now, everyone should invest in value funds, but the caveat here is, what happens is in the market that there are times where certain style works and certain style does not work. As I was talking about it earlier, that 2016 till 2019 was a period where value stocks did not do well because market structure was such that it was ready to reward few companies who were growing and reward disproportionately. So anyone who did not have a high regard to margin of safety or PE multiples or valuation, those kind of people and those kind of funds did well between 2016 to 2019. Now, market approach and market characteristics changed post-pandemic. And because of that, since there was a broad-based economic recovery, value styles have started to do well. So our advice is always that you create a mix of portfolio between different styles and different caps. Your value style should be your anchor portfolio. It should be around 20 to 25% of your long-term equity holdings if you are investing through mutual funds. And around that, you build a periphery of different styles like growth, mid caps, large caps, and hence you create a portfolio, a long-term portfolio of mutual funds, which should take care of your long-term financial goals. Now, intermittently, there will be periods of 1 or 2 years where growth does not do well, like 2020 and 21. There could be periods between 2016 to 2020 where value did not do well. But overall, longer periods of time, this approach onto the portfolio with different styles will ensure that you achieve your financial goals through proper equity investing. So that should be your approach. A basket approach, a bouquet approach works wonders for a retail investor. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.